Hi everyone, I would like to thank you all for attending the interview today. We will be speaking with Tom Lloyd-Jones, who is the founder of the Zenzic Estate Planning Service. It should only be a 30 to 45 minute conversation, and we'll just run over the key highlights of the product, and then we'll open the floor to questions once we have finished our discussion. So Tom, can you just give us a quick background as to how you got involved in the market?
Yeah, so Zenzic is a real estate credit investment manager, and we've been in existence since 2014. Around 2019, we said to ourselves, do we expand our product range to encompass an inheritance tax offering? Yeah. And because we'd seen, obviously, other participants in a similar space. And so the genesis of it really was to broaden the access to what we're already doing to a different investor base.
Yeah, absolutely. And just in terms of the product itself, what do you believe differentiates you from the competitors in the IHT space?
Yeah, great question. So I think there are probably four key differentiators. I think the first, without sounding too much like I'm on a sales mission, is the return. But the reason why I focus on that first is that was really the genesis of the product in terms of its design. Is we said to ourselves we wanted the product to stand on its own 2 feet, irrespective of the inheritance tax saving. The inheritance tax saving should be a kicker, if you like, an added bonus rather than the raising detriment of the product. Yeah. And so we, since inception, since 2019 Q4, we've delivered a 6% return, which is the market leading real estate credit inheritance tax product. I think most of, and by some way, I think as well, other products I think cluster around the 3 to 4% return, and we're quite proud of that. I think the second key differentiation is our sector specialism. So we only do real estate credit, and that is a function of the firm's DNA and the team's backgrounds. We have, in my view, which is the third differentiator, I think one of the best real estate credit teams, not just in IHT products, but across real estate credit market in general, drawn from the likes of Brookfield, EY, CQS, where DRC Capital, where we've just been doing real estate credit for a very, very long time. And that sort of narrow specialism, we think, is a real strength in our offering.
Yeah, absolutely. And in terms of the risk management of the portfolio, how is that managed internally?
Yeah, so we look at risk on sort of 2 key levels. We look at it on a macro level, we look at it then on a sort of sector level, and we look at it on a portfolio level. So I think we'll come on to discuss some of the macro analysis a bit further, but that obviously informs the portfolio. But then before we make any investment, we cover 26 subsectors of real estate. I think that's the key thing for people to appreciate, is that it's not, it's quite a diverse sector within it. It's not sort of clustered around office and retail, which you would sort of get the impression if you read mainstream press. We do a lot of top-down analysis on those sectors to determine where do we think the best risk-adjusted returns are, what are the fundamentals, and we search basically for sectors with strong secular tailwinds where the demand is going to hold up in most economic circumstances. Then in terms of the portfolio, so we have quite a detailed sort of portfolio framework where we say we're not going to be overexposed in terms of location, in terms of sector, in terms of borrower. Yeah. And then we have another thing that differentiates us is our monitoring capability. So we have in-house monitoring team. One is a QS and one is asset management specialist from Rubin Brothers, where we visit every single deal every month to check progress, talk with the borrower, see how things are progressing by reference to the business plan. And so it's covenant heavy and monitoring heavy. Yeah.
Very good. And that, as you mentioned, leads us quite nicely on to the next question. But how do you feel the current macroeconomic conditions, such as the inflation and increased interest rates, how do you feel that affects the product and its appeal?
Yeah, so if I scroll back sort of 12, 18 months to when the rate hiking cycle began, when that started, we spent a lot of time thinking about this question. How do things change in the context of moving from 25 bips to 525 bips as the reference rate? And there were 2 key things we looked at. The first thing that we saw is that it was going to reprice senior credit in lenders' favour. So in the era of 0 interest rates, it was difficult to generate a good level of return in in senior credit positions because the reference rate was so low.
Of course.
And senior credit risk, in our view, was undercompensated as a result of that, like all investments. The first thing that's happened there is that we've seen a really great pickup in yield on senior positions.
Yeah.
And that has enabled us to reprice our credit like a lot of other people favourably. But the flip side of interest rate rises is its effect on asset prices. Buffett says interest rates are financial gravity. They drag all asset prices down. And this you have seen most obviously in office, where the asset values have been significantly impaired, partly due to the interest rate rise, partly due to changes in usage and working from home phenomena. But it's the interest rate rise that has triggered that reappraisal. And that comes back to what we do at the beginning, when that top-down analysis of sectors that are going to be less resistant to things like monetary policy change. So we have never invested in office and retail.
Yep.
We focused on alternative sectors where the fundamentals we felt were stronger, and that has been proven out in the last 12 months, certainly when everybody's portfolio has been tested.
Yep.
Where we see it going now is probably interest rates. I think the consensus now certainly is that interest rates have peaked and that they will be declining. That will have the reverse effect. Senior will have maybe its pricing power reduced slightly, but asset prices may increase.
Yeah, absolutely. And I do think it is worth mentioning, having Zenzic launched in 2020, it has already navigated some pretty difficult macroeconomic conditions. But how do you foresee future economic trends, to follow up on your last point, influencing the demand for IHT products?
Yeah. So I mean, the two key trends are obviously growing population, which I think we've seen recent statistics saying we've had the biggest population growth on record since 10 or 15 years. And then it's the increase in wealth that's concentrated in home ownership, which is then triggering a larger exposure to IHT. So I think last year was record receipts of IHT. It's projected to go north of 9 billion without any fiscal changes. So I think IHT is becoming more relevant to more people, primarily because of fixing the nil rate bands and the increase in asset prices, which are a sort of core component of people's wealth. So all things being equal, I would expect the demand for IHT to rise in accordance with the incidence of the tax.
Yeah, and you obviously mentioned the changing demographic of the aging population. Is there any other shift in the demographics that you see that would have an effect on the demand of the product? Rising population and an increasingly older population. That obviously is very relevant for IHT. I think home ownership is still the key driver in terms of IHT liability. And that boils down to what is your view on asset price inflation relative to, for example, nil rate band inflation. Nil rate band inflation seems to be at zero. It doesn't seem like it's going to get increased. Asset price inflation, I think the latest projection from Savills now is that asset price in terms of residential is scheduled to go up again at a decent lick. And it doesn't take much compounded annual growth in order to start dragging people into the net. So I think we're in a position where more and more people will find themselves having to deal with this issue. Absolutely. And in terms of the investment strategy, what economic indicators do you and the team typically monitor to guide the investment strategy? Yeah,
great question. I mean, we're very data driven as a firm. So there's the macro analysis that we look at, and that affects both where you deploy capital and how you deploy it, how you price it. But we also, as we've said, as I said earlier, we do a lot of research on a sector by sector basis. We cover 26 subsectors within real estate. And there we're looking at supply demand of real estate. We're looking at demographic changes or developments such as population growth, level of, for example, employment, income, and nature of the job market, where we're in sectors that are affected by local population. When we looked at PBSA, purpose-built student accommodation for students, we spent an awful lot of time looking at the supply demand in given cities of student accommodation versus the demand. So it's done both at a macro and a micro level. Macro being sort of affecting everything, obviously, and the micro is both sector and sort of and detailed demographic analysis.
Yeah, absolutely. And you have discussed there how you incorporate historic data into the investment strategy of the fund. In terms of any either macroeconomic or economic forecasts, how do they play a role in the fund's investment strategy?
Yeah, I certainly of late, interest rate has obviously been the key one. I mean, that is still sort of the fundamental law of the universe in our view is what is going to happen to interest rates. But fundamentally, what we aren't, our strategy is not designed to be buffeted by interest rate movements, however severe. I mean, and the recent hiking cycle, which was not only large, 500 basis points, but it happened so rapidly, was a really good test of that.
Absolutely.
Being able to pivot within different sectors according to different demand and supply fundamentals is vital to that. But we want to be fundamentally uncorrelated to big macro movements.
Yeah.
And real estate is a broad universe. It gives you the opportunity to do that if you can understand your sectors well and be able to move amongst them.
Absolutely. So I would say that Zenzic would, in terms of portfolio allocation, would be described as a core satellite offering. Could you speak to firstly what that means, and secondly how it would look in terms of people's portfolio allocation?
That's a good question. So core satellite broadly means, think of it in planetary terms. You have a Jupiter and then you have a moon as your Titan, and the Jupiter is obviously bigger than the Titan, but you do both at the same time. And the idea, I mean, our portfolio and our product can obviously be your Jupiter, can be your core, but what we've seen a lot of advisors do is team it with a larger allocation to perhaps a more established ZEPS BR competitor, and we're that works great for us. I mean, we've talked to a number of advisors who say, look, I can make 80% of my allocation here, and I can use Zenzic, which is higher returning, as a complement, and I can even shift from an existing provider to you. I can shift, say, 10, 15, 20% for a yield pickup without imperiling the BR relief, because that's one of the good things about the products is that you can switch out without restarting the clock. So we're happy to be a core or a satellite, but certainly the satellite use has been something that we've noticed.
Yeah, and I think it's worth mentioning that one of the benefits of ZEPS is that in terms of portfolio allocation that it will be exclusively property investments.
Absolutely.
Naturally, with other IHC products, there is a range of sectors that they deploy into. Having the benefit of knowing that your money will be allocated into property is
I mean, we think that narrow sector specialism is really important, because, as we've said, real estate is a broad church, right? If you're just covering that, you're covering 26 different subsectors. So to sort of then go into sort of forestry, solar, infrastructure, we just wanted to do what we know. Our circle of competence is real estate. We know that very well. That's where we want to. That's where we want to sit.
So the next one is a pretty topical question, but what role does ESG factors play in the investment strategy of the fund?
Yeah, it's becoming an increasingly important consideration. I think sort of 3 or 4 years ago, there was a genuine debate about whether ESG and returns were antagonistic. Could you get both at the same time, or did you have to trade one for the other? But I think more and more now, it's becoming a real plank in value. It's kind of a real component of value. We see this most obviously, for example, in the student sector where we've invested recently. And there, for example, your buyers will often be institutions who will quite openly reduce the price if they think, for example, your building is not ESG future-proofed, and that covers the obvious things like green ratings. But we go further than that. We try and build a sort of genuine ESG thematic throughout, and that covers, for example, how the building is built, the use of materials, trying to make it carbon neutral. We have solar panels on our roof, or going on our roof in Nottingham. We've already got one in Leeds. We're not quite at the level of energy harvesting that we want. I was having a chat with a friend of mine who's invested in an Aberdeen student asset. He tells me he gets 150% of all his energy from solar and sells the balance to the grid. Good. So I was immediately a bit piqued at that we went to that level. But and then there's sort of other things that we do on the residential side, where we've been a big supporter of SME home builders now for nearly a decade. And we've done that for a number of reasons. One, we think in value terms, they offer the best risk-adjusted returns in that sort of residential sector, but also they build homes for people to buy and live in rather than investment assets, and they are active builders. You know, they buy land and they want to get on site and they want to produce homes, and in some small way, we hope that can be a contribution to trying to solve this long-running housing deficit that we suffer from.
Yeah, apologies to anyone that did want to listen to the King's speech, as I know we are slightly conflicting with that, but with one of the key focuses of that going to be improving the rate at which affordable housing is built. How do you see ZEPS helping in that context?
Yeah, it's quite exciting, this actually. I think there has been a problem in terms of land supply for home building. I think if you go back to its roots, that's the first thing that has to get solved. Everything else is logically afterwards. If Labour can increase the supply of land that's eligible for home building, then that in turn will see an increase in demand for development finance, which is where we can come in. But specifically at that SME level, one of the things we did when we looked at the residential sector was ask ourselves why the level of output from SMEs relative to the continent is so low. If you compare it to Germany, their contribution of total homes delivered by SMEs is something like 15% higher than the UK.
Yeah.
And where we got to was ultimately finance was a big part of the problem. It was just getting the finance. So if Labour can solve the supply of land issue, we can, with others of course, hopefully supply the capital demand issue.
Absolutely. Well, just last question from me, Tom, before we open the floor to questions. Where do you personally see Zenzic in 5 years' time?
Yeah, great question. Well, you asked me this now, and we'll come back in 5 years and test it. So yeah, I probably exactly. have to temper how grandiose I'm going to be in that light. But where we want to be is we want to be a leading real estate credit manager in Europe, covering the alternative subsectors of real estate. That's where we see at the moment the best value opportunity, and quite frankly the most neglect in terms of capital. So we've got quite grand ambitions, which hopefully will come to fruition. But I'll come back in 5 years and we can benchmark the reality against the aspiration.
Absolutely, that's great. Well, Tom, I would like to thank you very much.
No, thank you for having me.
Speaking today. It was a very interesting conversation, and I would just like to give everyone an opportunity now to ask any questions if they have any. Guys, has there been anything that's came into the chat?
Not that I can see yet.
Okay, well, if there are no questions that anyone has, we will conclude this discussion, but I would like to thank everyone for taking time out of their busy day to do so, and I look forward to hopefully speaking with you all soon. Thanks very much, and enjoy the rest of your day.
Great. Thank you.
Sure.